Said on the Hive Mind is a recommendation to buy or sell securities or tokens. This podcast is strictly for informational purposes only, and any views expressed by anyone on the show are solely our own opinions, not financial advice. Hi, everyone, and welcome to another episode of the Hive Mind podcast. I'm your host, Jose, and with me today, as always, I have Ceteris, Jan, and Duncan. But yeah, Echo is Kobe's new sort of like investment club, like crypto angel list platform. Where for full disclosure, we at Labs we're incubating something like a competitor called Legion, and yeah, we spoke to Kobe about it, so we're aware. But I've used Echo. I think it's really cool. I think he's executing really well on it, and just given his brand and stuff, it's gonna do well. I guess my main sort of like interesting point about the model, and would be keen to hear your thoughts, is just and this is the issue with ICOs too, and with all this stuff, is the adverse selection problem, right? Which is with investment clubs, you have this thing, okay, who are the users of investment clubs? Like ideally it's someone who's like super smart, has a lot of alpha, but hasn't yet made it. Right. And so they need, and also has access to deals, but hasn't yet made it somehow. And so they need extra capital to be able to maximize their allocations in these deals. And I guess the problem is there aren't that many of those people, right? Like just by virtue of, if you're super smart and have alpha, you generally tend to make good money in this space. And then you don't really need external allocations. And then at the same time, like on the project side, I think, like, how are projects thinking about their rounds? They're thinking about them in terms of, how do I maximize the sort of value add per dollar of capital invested in my round, right? So you want to get the highest value, like VCs, the highest value angels, and really try and get people that are going to work for their allocation, assuming your project's like popular and oversubscribed. And in that case, like, you don't really want to like give allocation to well, this is my thesis. I think it could be definitely proven wrong, but you don't really want to give allocation to an investment club, right? Like if I'm giving allocation to an angel, I want them to be fully incentivized themselves. Like I want to give the minimum I need to fully incentivize them. And if it's being diluted amongst a bunch of people I don't know, then it kind of like defeats the point. And yeah, obviously ICOs have similar issues, but yeah, curious to hear you guys like thoughts on this.
Yeah, I fully agree with everything you just said. I think there's some scenarios where it makes sense, is through like distribution to like a wider audience and getting them in at a good price. It's kind of the whole idea of like, tokens that, almost do no VC raises or launch organically, like grassroots ones that, launch at a really low price and do well over time. They build a super strong community, right? Because they've made a bunch of people wealthy. And then like every one of those people is essentially just like an agent of, promoting that project, giving feedback, just it's a massive distribution channel. And you really see it when it's like, okay, a few VCs have made a lot on this, or like, thousands of people have made a lot on this, or like even tens of thousands of people. So I think that where it could be cool is for distribution, where obviously like you need a KYC and stuff. Do you need to be an accredited investor to?
Yeah, you do. Okay. I guess the main thing, like another point worth making, I should have probably made this clear, is like, I think this is desperately needed. I don't think the status quo definitely benefits us as DeFi Ventures, but I don't think it's like optimal for the space. For sure. Right? And basically the status quo is either projects do these like private rounds that are by necessity like cheaper because there's less people that can buy into them, and then they eventually, when they go public, they're at like multiples of that round, right? And realistically, some VCs add a lot of value. We think we're definitely one of them. Others don't add that much value, and there's definitely angels that add a shitload of value, and also random people that add a bunch of value. Like we've seen it in every community, the Chainlink gods, the Thor maximalists, like there's these community members that come in and are MVPs and almost team members. And so I think the promise of one of these ICO platforms is that you can like basically maximize the utility per dollar of capital raised, right? You can try and get the people that are going to be most value add and to come in and also like build a community, right? Like one thing that our Legion team says is like, yeah, your first 10 employees make your project, your team culture, and your first sort of like 100 community members make your community culture, right? So if it's a bunch of moon boys, you're probably screwed. Yeah.
Yeah, so I think that's where, like, obviously being an accredited investor prices out a lot of people from this platform, which I think that's just a regulatory thing. Like, you can't really get around that. It sounds like maybe Legion is
Yeah,
Legion
I thought that you could.
non-friendly?
I actually thought that you didn't have to be for this. I thought that
For
was part of
Echo?
the.
Yeah.
I don't know for sure. I know I signed up. I had to answer a bunch of questions about like net worth and risk tolerance and stuff like this. I don't know what would have happened if, I don't know. I assume you have to be accredited. Maybe I'm wrong.
Is Legion, do you have to be accredited to do like the ICOs, or how is that being structured?
No, based on the license that Legion's going for, you won't have to be accredited, but you do have to exclude the US, or do like Reg S, which has its own things.
Yeah, so I think let's just pretend that everyone can invest in these to make the
Yeah.
discussion simple. I think obviously the biggest challenge, and you guys would be well aware of this, and Kobe is also obviously well aware of this, is just the adverse selection point, in that like all the most prestigious projects are still, regardless of regulations, going to want to raise from the most prominent VCs. When they do angel rounds, they're going to want to handpick the angels that they invite. They're not going to want to use some third-party platform. And there's like this whole meme, right, where it's the guy who doesn't think and buys 6 figs of your token and leaves you alone, and then the guy who buys $10 is in your Discord 24/7, like asking questions, right? And so,
but those people can be valuable too. Like, I guess where I think it's interesting is like, yes, that's true, but there's also, I think, a scenario where, and like the adverse selection is real, but I also think there's a scenario where it's like, okay, you open up the seed round at like a very, cheap price, and you have some sort of reputation system on Echo or something, and you let like 1,000 people invest like a few $100 or something, or however much you're trying to raise, and then you essentially get in 1,000 people at a really low price that, like, if it does, like, I don't know, like, I think Monad raised at like low, like tens of millions in their seed round, and they'll probably gonna be launching a multi-billion-dollar valuation. So it's like that could be potentially 100x. So like if you let let's say
I think some of the launch pads have done this. Like Binance's launchpad did this thing where it's like you can buy $1,000 worth max, and then as soon as it was trading like 50x that.
Yeah,
and so it's just like a way to give a lot of people an easy win.
And launchpads are similar, but don't really get the benefits of targeting your user base, right? That's like Launchpad is just a bunch of Jeets for the most part. Whereas here you have a scenario where you can kind of handpick. So I agree with the adverse selection thing. It's kind of a question of, so there's a few moving parts, right? Let's use, I guess, Ansem as an example. Do you give him a 50K allo? So let's say you have 250K that you'd go around to angels. Would you give 5 people 50, or would you do 250 to him, right? And let's say it's a standard 20% of profit model, right? So like he gets 20% on the other 200, he takes the 50, he gets 20% of profit on the other 200. So depending on how high it goes, like his exposure kind of changes above 50. But the trade-off is you probably have a bunch of randos that are not gonna do that much, versus is it better to have like a targeted group of 5 people with much larger followings than the sum of the randos of the people?
Yeah, but I think let's take that example. Okay, so Ansem has 50K, he gets 200K to like do to his Echo group, so you could get 400 people at $500 each. And like if Echo had some sort of like ranking, obviously if it's just like random 400 people, you have no idea who they are, then I don't know. But like,
well, you're outsourcing the whole thing of Echo, I think. So like what you're describing is more so the approach of Legion. Like what we're building is basically you want to have a reputation layer at the base layer that allows you to differentiate between different people, their value add, like what they contributed to different projects, like degen scores, like on-chain metrics, like Twitter, the Twitter score, like GitHub commits, like get a feel for who these people are, and then you can like hand select who you want to participate in your sale, right? And I feel like with Echo, what you're doing is basically outsourcing that to Ansem, right? In this case, like rather than you handpicking each member, each participant, you say this influencer has a really cool community. I want to just like tap into that. And I think to the extent that these people do a good job, like nurturing their communities and stuff, it could work.
But there's just this hundreds of people in their thing. There's no way they're selecting. You know, they're being very kind of programmatic with the entry process.
It is like, do you want? I actually think it's, if you get Ansem's following, because he has a massive following now, then you're going to get a lot of like free marketing.
Yeah, but it's like, it's a bunch of people that are following with 10 followers. Like
I know, So,
or you get like 5 Ansems each with a bunch of following and massive following, and them being the megaphone.
So imagine having like 400 people, $500 each, but they all have like between 100 to 1,000 followers on Twitter. It's like, that's some really good distribution. And like those people, you know, if you were to figure out the reputation around that, and those people are like trying to grow their following, and like that's a really strong community. And like some of them are really thoughtful, some of them are not. But like if you were able to handpick or like have some reputation layer, like Jose's talking about, where you put people who are just like on the come up, you know, maybe this is their first cycle, their first time in crypto, they don't want to invest too much money, but you give them a good deal, and like they're active on Twitter trying to like, you know, learn and build their following. You give them a good deal for like $500 to $1,000, that 100x's. It's like all of a sudden it's 50K to 100K, and you have 400 people that just got in on that. Like you're going to get a ferocious community, just like literally constantly talking about this. I think if they are able to do that, and that's a hard thing to do, can they do that? Does Legion have a better chance of doing that with their model? I think that that's incredibly valuable, because yes, Ansem and 5 other guys might have like a big following on Twitter, but there's some problems with them. It's like, you know, they might already have a lot of money. Their communities could be like very similar. They're not going to like, they have other investments, so they're not going to be focusing all their time on this. Like these like 400 random people, like you're going to get probably 100 of them who this is like really life-changing money for them, and they're literally going to become like your project.
Like naturally, as your number gets large, like they can't write, like their exposure also gets, you know.
I know, so that's what we were saying, between $500 to $1,000.
Yeah, so it's not hundreds of people, right? That's like tens of people.
Well, on the example you gave, where you have a
200K.
200K allocation to give to people, $500 for 400 people, or 200 people at $1,000. It could, I think that could, if it was successfully done, and it would take a lot of time, but it's like not only just the Twitter following, it's telling your friends about it. It's, you know, it's all these other things that like, you know, just
I think
because Anson has like a big follower number on Twitter, like I don't know if he's worth like more than 100 people who you've just 50 or 100x that are now like literally like dedicated to me, to project.
The most like sort of fertile market segment for this, because is basically like the big private rounds that projects do before they launch their token, right? Like that's really, because I think the early stage stuff, you benefit, you kind of just want a VC that'll give you money, stamp their brand on it, ideally if it's a brand name VC, and then like leave you alone, or at least like maybe introduce you to some people. You don't want a bunch of random people spamming all the time at the early stage. But once you're getting closer to launch, like projects are basically, because there's no ICOs, they're doing these like discounted private rounds, right? The exception maybe being Jupiter. They're doing these discounted private rounds and then going live with their token. And I think like rather than a discounted private round where you're giving it to like 4 or 5 VCs, that's where like the EV is definitely for me way higher in like distributing to tens of thousands or hundreds of thousands of people in smaller size who can now all participate and basically capture that alpha instead. Is how I'm thinking about it.
And this is almost like a better way of doing an airdrop, where it's like people have to put up capital so they feel more invested, more tied to it, you know, less likely to dump. You can put them on a vesting schedule. And also you get to make sure there's no like civils, like because they have to attach to their identity in some way. And you get the, you know, a similar distribution if you were to do it at a private round or something. So I think that like this is just a much better way of doing an airdrop, right?
I agree with
Because
that.
you know, you could get 100 real people with like a few hundred followers and like, you know, actual real people, or you could get 100 of Sisyphus's wallets. And it's just one guy who's not going to tweet about your project. He might be like, oh, Jupe, go up and just dump his entire stack. But it's like, what would you rather have in terms of like
Also much harder to Sybil, like much harder to Sybil and ICO with actual KYC
to do, yeah,
than this. So
And
I think it's like very promising. I think like there is clearly market demand for this. To me, like the Pendle YT craze and like meme coins and the pre-sales and stuff, to me that's all like people want to get into stuff earlier and feel like they have a fair shake. I don't know. Like
No, I
Pendle's
agree with
basically
you.
become an ICO platform right now. Like that's their main, I feel like, business is just people who want to buy Eigenlayer or who want to buy Ethena pre-market.
Yeah. No, I agree with your point that this makes most sense for like the late stage
Yeah.
private.
It can actually scale because otherwise it doesn't really scale. There's just not enough capital.
Yeah, this I think is for distribution.
Yeah.
All right. There's also like we touched in some of the pre-show and like how this affects like funds as well. There's this adverse selection also kind of applies to funds, right? At a certain size. I know Paradigm announced like their $750 million fund. Obviously, those guys are one of the best in the space. But there is this, I think, adverse selection that also happens with larger funds where, you know, you're basically like when you're more incentivized on the management fee side than the performance side. Like bigger funds drastically like compress your performance, especially in this industry when there are that many opportunities to ape into. And the really like to some extent the really smart people, if they really have alpha, are incentivized to just manage their own money or squat up with their friends like we did and manage our own money together, right? Yeah. What do you guys think of that?
No, definitely. I mean, I think if you look at the numbers, you know, in terms of the amount of VC dollars getting invested, if you look at, you know, the previous cycle, so how much money was going in 2021, 22, and compare that to what it is now, it's night and day, right? Part of it is you know, the previous setup was kind of a late zero interest rate phenomenon type of dynamic where there was always kind of exit liquidity, money was free, and so it was just growth at all costs, and VCs, you had the SoftBanks and Sequoias that were going to be writing these gargantuan checks, and so everyone before them was also comfortable investing because you knew that money was coming in behind you, and so once you kind of had the big washout in liquid markets, the appeal of doing these 9-figure rounds, right? Not even like, or like high 8-figure to low 9-figure rounds, still happens, but to a much smaller degree if you kind of look at what the trends have been. And so, which makes sense, right? And it bodes well for us as well, where we kind of focus on the early stage, and you know, it's part of an edge there, and it's great because now teams are also really kind of focused on doing that earlier stage and then trying to go liquid afterwards. So I think it's a much harder market to invest as a larger fund now. The returns aren't there. We've also yet to see what the reckoning is of these unlocks, right? We've harped on this a bunch, but it's especially relevant now because what a lot of the funds, and this happened before, was in reinvesting on paper gains, right? And you're not actually realizing anything. There's no actual realization. It's just markups and raising on markups. And so I think with crypto, we've seen a lot less of the 9-figure raises, and so we'll kind of see what happens. I think there's probably going to be some level of reckoning where narrative can't really offset the increase in new supply, and the venture stage or crypto ventures, really the edge is kind of always been in the early stage, but even more so now. And so it's tough. Like we've thought about trying to go with a larger fund, but ultimately decided against it for, you know, a whole host of reasons. But one of them is certainly just the massive alpha decay, and you're just playing kind of a different game.
Yeah, because like I guess with crypto, right? Like the really good deals that we've seen are like these pre-seed and seed rounds where there's only a certain amount of allocation. And if someone has like, a multi-billion-dollar fund, it's almost always better to like do that
They
allocation.
just can't spend the time. They can't spend the time to DD it and stuff for that.
Not
Yeah,
even-
because it's like a nothing burger to them.
afterwards too. Like they just, in order to deploy that much money, if they were to do it early stage, they'd have hundreds of portcos, right? And so you kind of assume it's just money and nothing else.
Yeah, and then also I guess on this point, on a question from my end is, so I think like A16Z raised like a $3 billion or $3.5 billion fund kind of last cycle in like 2021 or 2022. When do they start collecting management fees on that? Is it like, because obviously there's gonna be capital calls and stuff, but is it like the second they raise the fund, or like as they call the capital and deploy it? How does that work?
No, it's you collect management fees on committed capital.
Okay. Yeah. So, and then the committed capital is probably based on, how quickly you can deploy it is how quickly.
Well, no, it's like what's been committed, called down is what I so you say I'm into this fund for $1 million. I'm starting to charge a management fee on that, but I'll
Day
call
one.
down for for
That's
250.
crazy.
Yeah. But then the carried interest is only
Now
like,
you understand.
upon selling.
Yes, exactly.
Yeah. So it's not when they actually deploy the deals. It's just, but do they have like, I think that I've heard that there's some guidelines or restrictions around like you need to deploy X amount by this date.
Well, yeah, but if you're charging on the entire amount, then you think about it, you could like sit on the first capital call for like 2 years.
I know, but
And
that's
normally
what
a deployment period. Yeah.
yeah. So if there's deployment periods, right, like it creates this weird incentive structure where it's like, okay, there may not be enough good deals to actually take this amount of money. So what we're doing is just bidding up rounds so we can fit in more money to like reach our deployment schedule, doing rounds that like, we think are good, but like not the best, just to deploy this money. So that's where like kind of the adverse selection comes in. Like I think a $3.5 billion fund is a lot to
even in the venture. Yeah. And it's part of the other reason why they won't draw it down immediately is the main calcs are a function of when the money was called down, right? So if you basically call the money down and don't deploy it, it really reflects poorly on your return calculations because it's a drag on performance.
I'm wondering, like, they must still be deploying that if they raise that in 2022.
Yeah, there's if you look if you look at the numbers, CryptoRank has a site that has pretty good like monthly distribution, and you'll see like the vals, or rather the amount raised per month is basically it's kind of hovered between like 500 and 1.5, or rather the amount like deployed into deals, but the deal count has kind of gone up. So you're seeing deal count's gone up, but deployable capital hasn't. So just more early stage stuff. Mm-hmm. And it's something we've seen as well. There's only been a handful of these larger rounds that have really kind of happened.
Yeah. So I guess it's like for some of our listeners, it's like kind of be careful about like if you want to get, because there's all these crazy returns in crypto VC, and it's just like, be careful about giving money to these like crypto VC funds and like really do your diligence, because this problem definitely exists on these kind of mega funds, because there's like really not enough good deals to deploy that level of capital, especially if there's time pressure around the deployment period, or like for them
I think Andreessen's pretty smart. They have like a very long time horizon for this stuff.
Yeah,
and they have some good stuff in their portfolio.
Yeah, and I'm not meaning to. I'm just more like calling, like I'm just kind of pointing to them because, picking on them because they have, they're obviously having an incredible track record and stuff, but still, nonetheless, like $3.5 billion or so to deploy in crypto is difficult.
For sure. All right, we had one last thing on the docket, which was ETH issuance. I read through a little bit beforehand, but I honestly don't have a great take. I assume Ceteris, you do. So maybe we can just all listen to you.
I can give like the TLDR. Basically, there's discussion in changing the ETH issuance curve. Reasoning is that So they don't want the stake rate to get too high because there's a lot of like negative externalities with that.
Is there a quick example you could give of that?
The
Like
negative
what?
externalities.
Like why is it bad when there's too much?
That's what I was about to do, Duncan.
Oh, sorry. I thought you were gonna move on to the next thing.
So, okay, there's this. Yeah. Okay. So basically, first of all, ETH has made this big push on like making ETH money, right? And so the more people that stake, the more ETH is issued, and so you have like a bigger tax on non-stakers. Okay, and that is seen as like a bad, making ETH more expensive to hold, just as like native ETH and not as a staking representation, is seen as like detrimental to the moneyness of it. Okay, to like the money thesis. And so that's kind of one of the side effects. Another side effect is, so if you think about here,
I guess should we, because it's gonna be hard to like remember.
Sure, we can talk about that. Yeah,
I think that's like massively overblown. So part of it is the idea is like you're taxing those that don't participate at an increased rate because with ETH issuance goes up as more is staked, but it's not that much. Like we're talking about relatively negligible amounts of issuance, and so I think like directionally that's correct, but the magnitude of it is so muted that it's really doesn't make sense for me as an argument that it's like taxing the non-stakers is if the group gets the stake.
Yeah, I don't think that one's the strongest one. The strongest argument, which I guess I can go to now, is
Yes.
so ETH doesn't have like in protocol delegation, right? And so if you're a retail staker, you're either going to be a solo staker, which is not really retail. It's like sophisticated individual, I would say. Otherwise, you're just going to buy like a liquid staking token or something, right? And so if you don't stop the incentivization of stake, what you're going to have happen is more and more ETH is going to be staked, and then more and more ETH is going to be staked in like liquid staking protocols or LRT protocols, right? And then these protocols end up becoming like too big to fail. And Ethereum now is dependent
They're
on
already too big to fail. Lido's too big to fail.
Well, Lido's declining now because the LRTs are taking its market share, right? Like Lido's under 30% now.
I think that if Lido were to have a bad issue, they would definitely do something.
Well, this is the point. This is like
something like that.
And so if you think it's already too big, then sure. But like this is the rationale for why they don't want it getting too big, is because
governance of Lido and Eigenlayer would effectively be the governance of Ethereum is like
right.
The other issue that they point out, right?
Right. And then if you think about it too, like if everybody stakes, then the real yield to everyone is zero, but there's still risk in staking because you still get slashed and everything. And so what that also incentivizes is people just to chase other external yields, which is why you get all the LRT stuff. And people will start chasing like more yields with those. And so that's like, in my opinion, that's the biggest side effect that I think has merit to it. Another one was around like solo stakers. If you think about like solo stakers, they're probably not too swayed by the yield they're getting because a lot of them are just kind of like diehards. They're passionate about this. They do it as a hobby. But if you think about the institutional staker, they only really care about yield. And so if you reduce yields, you are not going to really reduce the solo staking amount, but you will reduce the institutional demand for it in a sense. So yeah, there's been these proposals to like change the curve. There's like this hard fork coming up, and so that's kind of the time to do it. There's been a ton of pushback in the ETH community. I think that the ETH community is kind of like insecure about the way like Bitcoiners have always framed them changing the issuance schedule all the time. And since they have been making this massive like moneyness push, there's a lot that don't want to touch it like anymore for the rest of the protocol and just like leave it as it is. And like there's also, you know, I don't know if the argument is necessarily overwhelming enough to change it because you can always kind of tinker with something and you can always change the monetary policy all the time.
Yeah, I think it makes sense.
And then yeah, just to go back. So in terms of like it's all trade-offs, right? So like you can make arguments both ways, and there's nothing that's absolute. But yeah, I'm pretty heavily in the camp that it doesn't really make sense to lower it. Because way back when we pushed that it would make sense to raise it. This was like in 2019, but that was more so an issue of kind of financial sustainability relative to the costs that were needed to operate to be a validator. And so that there it makes sense when it when there's like an existential issue with having the economics actually be profitable. But here, the LRT stuff is going to happen either way. The like adjusting this yield won't change that dynamic because the yield itself is so small that the amount of boost you get with the LRT tokens and everything else makes a material difference. And so I think like those would exist either way. And I agree, it's kind of bad for narrative. And yeah, I think the institutional point is a very good one too, where part of the sound moneyness is this. I think that narrative takes a big hit, and you certainly lose a lot of demand in exchange for, what really.
Interesting,
bro. No, I agree. Yeah, I think that makes sense.
I don't know. When I hadn't really looked into it, and I was firmly on the side of don't fuck with it. After reading the arguments from the researchers, I felt like they were actually like pretty convincing.
Yeah, I think there's
yeah. My main like counter argument to it is I think all that shit happens anyway, even if you lower the yield.
Exactly.
Like
that's the thing.
People will still, if anything, they'll chase more. If you lower the yield, they'll go chasing LRTs and all sorts of stuff more. And you're really just trying to deal with the fact that like ETH was designed to optimize for this like solo staker utopia, and you literally now have Lido and like a few liquid staking protocols, and so it's just like so much engineering effort went into like solo staking, right? And yeah.
So I've always had this take on the solo staking thing, and from like a philosophical standpoint, I get it. I respect people who like feel strongly about this. But you are designing for a world that doesn't exist, right? And you're making like a conscious trade-off decision to design for something that will never exist. And you do kind of see a lot of the downsides of that. Personally, I think that being a validator is something that should be left to professionals. It's like a hard service that requires a lot of attention. And I don't think individuals should solo stake. I mean, they can if they want. If they're like a crazy hobbyist, you still have people on Solana, even with the hardware requirements, that are like super diehards that still do it, right? And so those people are going to do it regardless of how much it kind of costs. So yeah.
Yeah. I'm curious to see where this goes. Who wins this political battle? Yeah.
Well, they already slowed down the churn rate so that stake can't. And a lot of people were pissed about this when they did it too. That stake can't grow as fast over the next couple of years.
I don't quite know what that means, but it sounds
well to enter and exit being a validator.
Okay.
There's like a queue that you have to work through, and they just made it take longer.
Okay.
Because like the amount staked went up super fast after Shanghai, like way faster than a lot of people expected, and so there's kind of like this panic of, oh shit, if we don't change this soon, Lido is going to have like 80% of stake in a year, which was a bit overblown. But one thing too on the Lido thing, seeing them go into
the Lido thing,
whatever, the liquid staking thing is, so they're kind of like quote unquote fixing the Lido problem, but they're replacing it with these LRTs. And so it's like objectively a more risky product to have, because you have these, because an LST versus an LRT is a completely different product. Like an LRT is an underwriter of AVS risk. Like you're creating, and they're all different. Like you're creating your own like products of risk and yield, and you're making conscious decisions of So what happens when one LRT is just like max degen yield and just goes for the highest yielding stuff, and then another LRT takes a more like diversified approach to get a lower yield, maybe less risky, and like, you know, where does capital go? These are like the new incentives now, versus an LST is not making any conscious decisions. It's just staking, right? They're not actually doing any, like an LRT is a much more active participant in that sense. And so you're replacing the vanilla LST with now these like LRTs. And so you're fixing the Lido problem, but you're making a worse problem potentially.
And it's just like one letter different, but it's actually entirely different set of risks that aren't even like fungible with each other. But all right, we had a good episode where I think we're gonna skip altcoin corner, right? Because it already went on kind of long. But just imagine Duncan shilling Banana and Synapse, or listen to one of the previous episodes.
Literally.
I have been prohibited from shilling Ethena on this podcast, but we'll start with a derivative topic of the MakerDAO drama caused by Ethena. So who wants to start there? Maybe someone can like set the stage and give some context on what happened.
I think, so yeah, if you take a step back, the launch of Ethena caused yields to like rise all throughout DeFi, right? Because Ethena started putting on this delta neutral trade, and the yield on the stablecoin was like 40+% organic, and then also all these incentives. And so it caused like stablecoin yields just everywhere to go up, because if you could borrow DAI at like 5%, people would just borrow DAI, take it, put it into Athenas, and by nature, this just kind of like raises all yields like across everywhere. And so more recently, so that's kind of like the backdrop of the impact Ethena has had on yields. And now recently, Maker's done this whole endgame thing, right? Where Maker has always been this very conservative, like boring protocol. For a while, like it was only backed by USDC. Then they started doing this RWA stuff, like T-bills and everything.
Well, yeah, when they started off, they were pretty avant-garde. Like, Maker was my first altcoin back in 2018, and like, yeah, they got, I think Rune leaving like solidified them more and more over time. But yeah, keep going.
But yeah, so anyways, they're doing this whole endgame thing, and they're trying to toss a bunch of like incentives on the protocol and everything. They're really trying to get DAI, like they scaled DAI relatively conservatively, I would say, over the last few years. And now they're kind of going full force on it. And they're also trying to own different parts of the stack, right? So they have this Spark lending thing that's like this money market that competes directly with like Aave and others. And so the recent drama is that Maker has decided to allow Ethena stablecoin to be used as collateral to take out DAI loans, right? And so now DAI has some of its backing with this delta neutral synthetic dollar, I'll call it. I'm not going to call it stablecoin. It's like synthetic dollar. And so this caused a lot of uproar because it does fundamentally change DAI's model a bit from being backed by like T-bills, USDC, and like ETH predominantly, to now relying on this other new dollar. And so Aave responded by pretty aggressive tactic where I don't know if it's gone through yet, but it seems there's full support of the team that they're going to turn they're going to change LTV to like 0% and not allow DAI to be used as collateral on their platform anymore.
Oh, I didn't even know that happened.
Because of the no prep for this.
It was on the docket.
It wasn't. It's not. I don't think it's gone through yet, though. It's just
it hasn't. Well,
yeah.
So I think there's two. Yeah, I think relations between Aave and Maker have definitely been worsening. Right, they were like very close partners, but then I think Maker launching Spark was a big was a big hit, right? Stani posted after they launched, like, because they said they developed this new primitive, and Stani said it was a fork of Aave, and it also went against some deal they had made previously, so that caused a lot of hate. And then I think their issue with this was not so much the deployment, because they've only deployed like 100 mil of DAI, but the forum posts basically authorized up to 1 billion, right, of DAI to be allocated to this. And so far they've only deployed 100, and they're going to be pretty conservative. Like, I think Maker in general has like one of the best risk teams in DeFi. So that's I think part of the FUD. And then there's also this like related FUD that Mark posted today, right, about how Maker is basically just like pocketing this Ethena yield and not really passing it on to DSR holders, and at some point DAI, like the DSR holders, will just go direct to Ethena. But
yeah, I mean, so another thing too is, yeah, so Maker and Aave did have this partnership for a while, but this is a trend you're seeing in DeFi, something that you could kind of see from like 2 years ago, that all these DeFi protocols are trying to own all these different products. And so Aave launched their own stablecoin that competes with DAI. DAI launched their own money market. Curve has launched their own stablecoin, right?
Yeah,
and they're all like going after the same market now. And then also Maker chose Morpho to do this USDC, this Ethena pool, which is again using like a different competitor. It's like a newer protocol. And so I think that kind of there's a lot of like politics involved in this, that it's not just like pure.
Yeah, I don't think you could do what Maker's doing on Aave though, because of the cross collateral model, right? It's just a much harder process to get things approved through governance, whereas Morpho Blue has this cool like isolated model, and you can also choose your parameters, right? Like for instance, on Morpho, the Oracle price right now is like hard coded to 1, right? Which means that as you're levering up on these like 94% LTV pools,
hard coded to 1 for what?
For USD. So the Morpho thing is basically DAI has put DAI, like Maker is lent. Sorry, it does make sense given the risk analysis, I think. But like
I remember when people hard coded UST to 1, and I was
but that's apples to oranges. I think the main reason it's beneficial is because when it's not, the second order effects of it not being hard coded make it actually so much more risky, right? Because anytime there's even a mild risk of there being a depeg here, and depeg being, somebody selling into the curve pool and the price being off, what that kicks off in terms of a reflexive sell-off, because you're borrowing stable against stable is far more catastrophic than kind of basically, because it can get because of mild depeg can cause a big unwind. It just makes the whole system unnecessarily risky, whereas I think hard coding it makes a lot of sense, and then parameterizing elsewhere in terms of the amount of capital in there and other stuff.
Maker's willing to hold. Maker's just willing to hold it until a repeg, right? Like they've done the risk analysis, and that's the case. And it makes it a much more attractive product, right? Like I think Gearbox is offering like the same thing, but it's just much tougher to sleep well. Speaking as someone who's done both, like it's just harder to sleep well on Gearbox when it's like an Oracle price, right?
Mm-hmm.
And you can get licked on a 5% move basically on USD, and the pools aren't that deep. And I think that was the other problem that sort of Mark had with what Maker was doing.
Yeah,
it's this was a big topic on Solana like 4 months ago, maybe, the MSOL depeg. And it's a bit different because it's a liquid staking token, but Solend just pegged the MSOL price to the ratio of SOL that it could be redeemed for, and MarginFi used the free floating price. And I mean, the problem with using the fixed price, at least like in the MSOL situation, is that there's always risk that a liquid staking token can get like a pretty bad exploit. And then if you don't liquidate, then like the whole entire protocol is kind of just screwed. But
Yeah, I feel like that's kind of the tail where if there's an exploit that's not necessarily like we've talked about Ethena before on the podcast, but I think we kind of were all aligned. Even in a really bad scenario, you're probably looking at like plus the insurance fund, like maybe like a few percent, like that you don't get back on. You maybe get like high not like 90% of your money back, like 90 cents on the dollar plus maybe like high 90 cents on the dollar in a really shitty scenario. In terms of mechanics, but in terms of like a black swan hack or something, then that could obviously be a lot greater.
Mhm.
yeah, but I guess for this is on Maker's like balance sheet, right? Using like
Yeah, and I think it would be useful because I know like a lot of people know what Maker and Aave are, but just like as a quick refresher, like it's like Aave, you can deposit assets like Ethereum and then like borrow, I don't know what the LTVs are, but something about like 70% of your Ethereum in like US dollars or like USDC or USDT. And then there's kind of all these different pools for a bunch of different assets, and kind of different assets have to get approved through governance to be borrowed against. And then there's kind of like an interest rate based on utilization and how much is borrowed. And then for Maker, they have their own kind of native stable coin where it's backed by kind of a basket of different assets. And, as Jose was saying, they just added USDE into this, which, is super highly yielding to kind of make DAI more attractive. But yeah, and they have like treasury there and all these different yield opportunities. But just as a bit of context, if people need it.
Also, yeah, I saw today that Synthetics is allowing it now to mint Synthetics stable.
Yeah. So all the DeFi apps are going to be competing with each other, but it's kind of interesting because it's like they all took different routes to get to ultimately what would be the same thing. And I think, someone who's done this really well is honestly Frax. Like I think he's like very methodical. Like from the beginning, Frax was just like
but Frax doesn't seem like it has market share in like any.
I know because they were focusing on the stablecoin in the beginning, and that is kind of how they thought. Like once you have like a distributed stablecoin, then you can kind of build these other products on it more easily versus like the other way around where like Aave built the lending market first and then is adding on the stablecoin, or Curve built the DEX first and then is adding on the stablecoin. So it's cool to see them all kind of converge. I personally
hedge fund, like that's the thing that a lot of people have been saying, oh, Maker's now a hedge fund or whatever. And to me, it's the like almost has been meme, like these things have always been hedge funds. Like Maker reallocated to treasury bills in the bear, right? It's just, I think Ethena is a better hedge fund, like or at least a higher like risk adjusted yield. It's definitely less decentralized than Maker, but yeah. And then the other thing I'm curious, sorry, go ahead.
It's more just the economics of it, right? It's you like you can classify them as hedge funds. You can also classify them as banks. They're just borrowing at one rate.
Sarah, for the sake of our industry, please.
No, but like they're same business model, right? They're borrowing at one cost and yielding a different one, and so it's just like a net interest margin business. And that's kind of what is you're starting to see issues come up on the Maker side, right? It's like, why should I deposit DAI into DSR and then be the recipient of the shit yield and allow the protocol to capture?
We're trying to explain what the DSR is quickly for people.
Yeah, so DAI savings rate, basically it's a yield that depositors of DAI can receive, and you can think of it, same way you deposit cash into a bank and then they take that cash and do something else that earns a higher yield and pass through very little to you, right? So it's directionally similar. And so in the same way that people are, waking up and saying, why should I collect 10 basis points in my checking account when I can put it in a money market? Similar dynamic here, where why should I kind of deposit into DSR? You can argue that the risks are slightly different, but I think the magnitude of the yield probably doesn't offset.
Yeah. So roughly how much their collateral is earning and then how much they're paying on the DSR, or not quite?
Or something, if I remember.
They're paying 15 now. They raised it a little while ago. It was
They got to
5.
be earning like.
But that's the thing is that Ethena
It's only on a small percentage of the DAI, right?
yeah
Yeah.
that they're
Other
earning
guys used in other places.
yeah.
So I think what is interesting is like Maker started off as like, oh, like ETH was collateral, and so it's like people can go deposit ETH and then create this stable coin out of it, and then that was like attractive to a lot of people to kind of have this like ETH based stable coin. Like people were saying, oh, this is like decentralized stable coin, like it's going to be massive for crypto, this is what's needed. And then it's just kind of like morphed into, as Jan was saying, the same business model as a bank, just kind of chasing this net interest margin and these higher yields. So it's now like not decentralized at all. It's like
became like a USDC wrapper, right? So it started shifting away from that original ethos pretty early on.
Yeah, it still has a lot of centralization vectors, but it is a lot more distributed in what those are versus when it was purely USDC for a while, right?
Mm-hmm.
So now they have like T-bills, RWAs. They're doing this Ethena thing.
Yeah.
But yeah, I don't know if there's like much more to say on this little feud or spat.
No, I think it would be interesting to get you guys' thoughts on Maker, because I personally, again, like it was my first altcoin. I haven't held Maker since 2018, and like it's a decent sized position now, and I just feel like, yeah, the end game plan. I don't know if anyone has taken the time to read through the sort of testaments that Rune writes up for the forums periodically, but those are really good. And the podcast he did on Blockworks was actually really good. Like the Empire pod that he did with Jason and Santi. And I just feel like it makes a lot of sense. Like splitting up Maker into these highly incentivized sub-DAOs with tokens, rebranding the whole Maker system. Like they're working with top branding agencies and marketing companies to like literally rebrand the entire Maker system, give it one brand rather than like these two, like MakerDAO and DAI, thinking about that. Redenominating the token, so it's going to have a new ticker, a new chart, like get rid of this like old token sort of bias that people have these days, and then just like launching a bunch of tokens around this from these sub-DAOs that are all that are all like going to be able to be pretty synergistic, I think, and also just make the governance less heavy on the Maker side. I don't know. I think the plans make a lot of sense. And I'm also like, since Rune came back more active, I just feel like they move so much quicker, and it just shows like the power of having a founder still active in the protocol, right? Like founder energy just like gets shit done. And since he's come back, like even the speed at which they did the risk analysis and stuff on Ethena, like to be first to market on this, like Maker would never have been first to something like this like before, right? And now they are, and it's like, I don't know, it's still like, I think there's like 5 billion DAI circulating. It has a big brand already. Like I don't know, I think it's in a pretty good spot as like an actual, it's the only like, yeah, I mean there's others, but at scale it's the biggest decentralized, like truly decentralized stablecoin.
Yeah, as I also have a decent Maker position. I mean, it's one of those probably where you just don't even need to mid curve it. You can kind of look under the hood and try and figure out how high you think it can run is one way. But so in the same way, stock splits favorably impact stock prices. Like unit bias is even more of a thing in crypto, and so that is certainly going to be a catalyst, even though it's already kind of telegraphed. I think there's that element. From like a fundamental perspective, it's not like super cheap, right? But it's still pretty good. It's trading, I think, like 20-ish times earnings. The tricky thing is, yes, their revenues crank up, but eventually you kind of expect the cost to also ramp up, right? As people decide, I don't really want to lend to you at 15. I'd rather either go elsewhere, which means they need to raise rates to attract the same amount of capital, which kind of squeezes their profitability. So you'll have that. On the sub-DAO stuff, I think that makes sense for sure, in terms of governance and being able to move swiftly and having a deeper focus on certain areas. The counter, I guess, is that it cannibalizes some value from Maker because now you have new tokens, but it's kind of like it's the value of those tokens is still embedded in Maker until those are out, right? Because you assume some of them will be distributed to makers. So the way to kind of capture that upside right now is, I mean, yeah, I was looking through. I haven't really seen anything specific in terms of how the thing
Maker chain, right? Like they've been doing a lot of research into that too.
So, yeah, I mean, I think in the grand scheme, you'll have a scenario where some of the parts is likely bigger than the whole with all of these new tokens, but you imagine Maker post split will certainly take a dip as value accrues to the other tokens, but up until that point, all of the value in those tokens can only really be reflected in Maker. So that's part of the thesis.
Yeah, no, and I think splitting into the sub-DAOs, and I don't know exactly what the plans are, but I think the thing we've seen like really clearly in DeFi last cycle and now again this cycle is like capital will go wherever yield is, and that's what like really like kind of gets things silly and like juices return. And so last cycle it was like in the basis trade as well, like in start of 2021, 50 to 60% for a few months on the basis trade, and like a lot of capital went into that to kind of bring it down in the second half of the run up. And then like obviously Luna like offering the 20% yield brought a lot of capital in, like $18 billion. And then like now we're seeing it obviously an evolution and like a safer version with like Ethena tokenizing the basis trade, which was a big one last cycle. And what's Athena's TVL now, Jose? Like a couple billion?
I think it's over
2 billion, I think.
Yeah, 2 billion. And then I think that Maker doing these sub-DAOs, new tokens, they can incentivize more yield, attract more capital. It's just kind of this constant fight between protocols on who has the most natural yield. And obviously the basis trade is a great way to generate that like natural real yield. But then it kind of evolves as the market like goes later and later stages into who can throw the most incentives at the yield to try and attract the capital. And that's when we just see like really silly rates and a lot of capital come in, and some pretty crazy things happening. Even an example of this, right, is Rune doing the basically on Rune or Thorchain, you can borrow against your Bitcoin or ETH at a 50% LTV. So if you put in one Bitcoin, it's worth 70,000 right now. You can borrow 35,000 USDC against it, and they give you a 0% interest rate and no liquidation. And so obviously that's just like a form of yield. And then what they do is they take your Bitcoin, they sell it, and they buy Rune. So it's like a very reflexive system to like attract capital and like really competitive rate, because you don't have to pay any funding to get leverage on your BTC. And there's reflective dynamics there that's capped at 4% of Rune's FDV. If that were to expand beyond 4%, I could see it being a problem. At 4%, I think it's probably all right. But it's just like these different protocols, all trying to fight for this capital and giving more and more attractive deals, because that's what we've kind of seen in crypto. Like capital flows to where the highest yields are.
Yeah. Basically it's like how do you get exposure to the best like risk adjusted yield as all these, other things are juicing it up. And so I think that's part of like Mark from Aave's thing with DAI is he doesn't like now how DAI has exposure to, and I mean, Ethena is a lot different scenario than like Thorchain. For instance, Thorchain's is not, it's like an insolvent by design, but
it's fine right now, but I could see it getting bad.
I think
it has potential to get really bad. But
it's only if you really raise the 4%.
Okay,
exactly.
Sure, but it's like my point on that is
the design is not sound.
It doesn't work it doesn't work at size, so it's not a sound design, right? But yeah, but just like plain USDC and like a money market or something will rise because of this, right? Because of all this stuff. And so yeah.
So I just think like for opportunities for people like looking at crypto, it's like there's a lot of opportunities in these reflexive systems, like if you can kind of time them well, but also like have to be aware of their reflexivity, because it cuts both ways, right? Like things can get really crazy when the market's going up, and then things can get crazy when the market's going down. So anyways, I just think that's going to be the driver that reinvigorates DeFi is just higher yields. It's like literally as simple as that.
That's what it always is.
Yeah, yeah, exactly. It's what it always is. And just the later you get into the cycle, the more crazy things people are doing, like throwing more tokens at it, or taking on more risky designs. And so it's just something to be aware of and kind of watch it play out. And it's also a really good indicator for like where are we in this cycle. Like when people start doing some really like designs that are not sound and like you could see them going wrong, or just like throwing silly amounts of tokens at it, or just that get crazy, those yields get crazy, is kind of a pretty good indicator of froth, and also leverage buildup in the cycle, right? Like the amount of leverage buildup that kind of like UST caused and then that had to unwind was a lot. And if you were kind of paying attention to that, you could see like a lot of things happen. Like,
yeah. Should we move on, or do people have more to say about
We can
this?
move
Okay, cool. We've been told we're awkward with the goodbyes, so maybe we can all say goodbye this time. Thanks everyone for tuning in, and we'll see you again in 2 weeks.
Yeah.
Thank you, everyone. Follow me on Twitter at Flood Capital for the real alpha.